Good evening, ladies and gentlemen, and welcome to tonight's webinar, Property Investing and Advanced Finance. I'm really excited to be here tonight. My name is Konrad Bobilak, and tonight I'll be discussing probably the most important topic you can ever learn when it comes to either property investing or just paying off your current home loan and smashing it in record time, or a combination of both, whether you want to pay off your home loan at the same time build a large property portfolio. And what I'll be focusing on tonight exclusively is financial structures, and specifically how successful property investors structure their large property portfolios and how they use leverage to build wealth. But more importantly, exactly what products they use in order to reduce their time that it takes them to pay down their bad debts, which is their owner-occupied properties, and how to use the right financial products and specifically what loans they use in order to accumulate good debts, which is your investment properties. Before we start, a bit of a disclaimer: everything I'm teaching you tonight is purely hypothetical examples. I'm not making any recommendations. Obviously, I'm not aware of anyone's specific financial situation, so some of the information I'll be covering tonight isn't relevant for everyone listening to this webinar. That's why it's important to get together with a good mortgage broker or a banker, sit down and have a look at your current situation. Number two is, my results aren't typical, and I'm not telling you that if you follow what I've done, you're going to build a multi-million-dollar property portfolio like I have. But what I'm going to do tonight is show you exactly what I'm doing myself. I'm actually going to show you some of the properties that I've purchased in the past and how they're structured. And hopefully you can draw some inspiration and get some direction from what I've done that can add value to your current situation. So here are the things that I'm going to be covering tonight, and this is a little bit in terms of, there's four key distinctions that I'll be covering. There's actually a lot more stuff that I will be covering, but these are the main points that I'll be covering tonight. Number one is how to pay off your current 30-year home loan faster than you ever thought possible. And the reality is, most people listening to this webinar right now, I'll show you how you can reduce a 25-year mortgage down to 10 years or less, depending on how creative you want to get. And that's without making any additional repayments. It's just by using the structure. I'm also going to talk about how to best structure your first investment property acquisition, whereby you're maximizing your tax deductions and you're maximizing leverage as well. I'm going to talk about, the formula the banks use in order to work out your borrowing capacity, which is called the DSR ratio. And, people talk about secrets to making money in property or secrets to making, to wealth creation. If there was a secret, which I don't believe there is, a lot of it is just knowledge that people don't necessarily have. But if there is a secret to the world, when it comes to the world of finance, I will definitely narrow it down to understanding the formulas the banks use in order to assess your maximum borrowing capacity. There's actually four formulas the banks use. The different lenders use different formulas. I'll be focusing on the main one tonight, which is DSR ratios. And also, I'm going to talk about the importance of balancing your property portfolio between cash flow positive and cash flow negative properties, and the importance of that plays if you're wanting to build a large property portfolio. The thing to understand is that in the current mortgage environment, we've got bank swap rates at 2.25%, standard variable rates around the mid-4s. In the major capital cities in Australia, rental yields are around the 4%, 4.25%. The situation is a lot of suburbs right now, depending on where you buy, you'll find most properties are cash flow neutral or slightly negative. And in a lot of instances, in Melbourne, there's only over 25 suburbs that are actually cash flow positive. So this isn't as important as it used to be in terms of building your wealth through property when you're dealing with an environment, that's 7-8%. But when you're talking about an environment where 4.25%, it's quite easy to do that. Now I've got a few messages here that I dropped out for a second. I just want to make sure that you guys can hear me right now, because can you hear me and can you see my PowerPoint? Just so someone can type in, yes we can, that'll be great. So why should you listen to me? Well, this is my formal education. I won't bore you to death with my credentials, but I've got a couple of degrees behind me. I did a business degree at Monash. I'm currently a real estate agent. I run my own company called Investors Prime Real Estate, and I've spent my entire career in banking, working for NAB as a financier. I actually worked for a department of NAB called Medfin, and also I'm a mortgage broker as well, but I don't do any lending at the moment. My background is managed funds, financial planning, residential lending, commercial lending, and asset finance. At one point in time, I had a mortgage broking company with 10 full-time mortgage brokers, a real estate company with 9 full-time real estate agents. Essentially, the most important thing is, while all that stuff is pretty cool, the most important thing about myself is that I'm actually a property investor myself. So I've been investing in property for a very long time, and I've spent the last 20 years studying the most successful property investors and developers that I could get my hands on, predominantly in Melbourne. So I spent my whole, basically 20 years of my life researching and studying successful people. And the key to success is very simple. You just got to find someone that's successful and literally replicate and copy exactly what they do. I'm currently semi-retired. I'm an author and full-time property investor. My book just came out in February called Australian Property Finance Made Simple. You can buy it in bookshops pretty much everywhere, or you can get it online if you like by going to bookonfinance.com.au. Check it out there. Let's get into it. Let's talk about understanding loan assessment criteria and a bit of industry jargon. Now, before we get to the good stuff, I'm going to make the assumption that no one on this webinar has any knowledge about finance. So I'm going to introduce you to a lot of basic concepts before we get into the good stuff, which is all the advanced stuff. So I'm going to go through and explain a little bit about how the banks look at you when you're applying for a loan or refinancing, which is basically the bank's assessment criteria. Whoever said money can't buy you happiness simply didn't know where to go shopping. So let's talk about lending criteria or loan assessment criteria. And I remember when I started working for NAB, the first week they give you these manuals, and we're talking about 5 or 6 volumes of the yellow pages here. And they said, read this, and if you read this, you'll be an expert on finance. And of course, no one reads anything. Mind you, after months and months and months of writing loans, eventually you use that as a reference, and eventually you become quite familiar with it. So I'm going to go through a basic loan assessment criteria. Whenever you think of lending, I want you to think of the word slice. And this is really how all the financial institutions in Australia assess you and your ability to borrow money. SLICE stands for security, location, income, character, and equity. And I'm going to go through each one of these in detail just to give you an understanding of how it relates to property investing. These are very important, by the way, because they do make your job as a property investor a lot easier if you really understand what they mean. The first one is security. Security determines the different levels of loan-to-value ratio and interest rates, meaning that the property that you're borrowing money against has been already assessed by the lender, and they've already established the level of exposure that is acceptable for them of a particular property. So if you look at residential detached houses in the major capital cities, there are pretty much no lending restrictions. The banks will give you up to 97% currently, so 95% plus lenders mortgage insurance capitalised at a fairly good interest rate, especially if you're a full-time PAYG. Townhouses are the same. Units and apartments are the same. However, if there's more than 50 in an apartment development, or if the apartment has an internal living area of less than 50 square meters, then there's a lending restriction, and you'll only be able to borrow up to 80% LVR against that property. Serviced apartments, 60% LVR, 50% LVR. Rural property, 50-60%. Commercial property, generally speaking, 70%. So loan-to-value ratio isn't only how much money you can borrow against an asset or property. Loan-to-value ratio is actually an assessment by the lender of the asset and its ability to drop in value medium to short term. You see, when the banks borrow money against property, the number one question they ask themselves is, if something goes wrong, how do we get our money out quickly? And what's the worst case scenario? How much money can we really lose? So if they're telling you that if you buy an average house in an average suburb, let's say from Melbourne in Moorabbin, for $700,000, they'll give you 95% against that property. So they're telling you really, in their opinion, that the ability of that property to drop in value medium to short term is only around 5%. But when you're looking at service departments in the Gold Coast, for example, or the major capital cities, the maximum exposure the banks are willing to have in that particular property is 50%, 60%. So they're telling you that if they have to sell that property at a fire sale price, they could lose potentially up to 40, 50%, depending on the time of the market and when they're selling it. Rural property is the same. You know, it could sit on the market for years and years, depending on how many acres you're talking about. Location of the property also determines loan-to-value ratio, or how much money you can borrow from the bank, and there are postcode restrictions around the major capital cities. Postcode restrictions are really imposed by the valuers, and the reason postcode restrictions exist is because the valuers assess a particular market or a suburb, and they perceive that if something were to happen economically, that particular suburb could be affected. And there could be a large volume of stock coming up on the market at any one time. So for example, in Melbourne, Docklands and South Bank a lot of times have lending restrictions where you can only borrow 80% LVR, and also brand new house and land estates. During the GFC, we saw a lot of house and land estates in Sydney in the western suburbs, in Melbourne in the northern and western suburbs. They had postcode restrictions where you could only borrow 70% or 80% against those properties. And generally speaking, in terms of location, if you target properties around the median price of your major capital city, and the property is located around the major capital city, you have no problems getting the maximum amount of money against that property. So generally speaking, as a really, really rough rule of thumb, 5 kilometres to 35 kilometres of the city, but not the city itself, is generally an area where the banks like to lend money. Because generally speaking, that's where most people live around major capital cities, and that's where there's a consistent turnover of stock in the major capital cities. Next one is your income, and your income is really not so much an assessment criteria, it's more to do with what information you need to supply the lender when you're borrowing money or when you're refinancing. Generally speaking, you're going to fall into one of the following categories. You're going to be a PAYG employee, where you've got a job, you're working for an employer and you're getting money paid to you and the tax is taken out automatically, or you're a self-employed person. You're working for yourself in a small business, paying yourself a wage, or drawing money out of the business. If you're refinancing and going for a new mortgage, what you need, I mean, the banks always prefer PAYG, by the way, over self-employed, because the perception is, and the banking industry is a very conservative industry, so their perception is that people that are employees tend to be more stable and have a more consistent income track record than people that are self-employed, because self-employed people are running their own businesses, and a lot of businesses fail in the first 12, 24 months. So generally speaking, you need 2 pay slips and one other, usually a letter from the accountant or a letter from your employer saying that you've passed the probationary period. This for PAYG people. 3-month bank statement showing consistent income is also sought after. If you're self-employed, you need to be ABN and GUS2 registered for 2 years. Even if you're not drawing down, you know, if you're not making 75 grand a year as a self-employed person, just register for GS2. Otherwise, you're going to have problems getting money, or there'll be loan products that won't be available to you. Sole trader, you need 2 years personal tax returns, and you need base statements for the last 6 months. Company trust, same thing, 2 years tax returns, personal financial statements, structure of directorships. They need to see where the money is getting paid into and who's drawing the money. Character. How clean is your credit history? I would say majority of loans are rejected because of definitely lender's mortgage insurance, and the second one is the extra credit file. So every time you borrow money in Australia, whether you go for a personal loan, a credit card, mobile phone, internet connection, there is a company called VEDA, and you can check out VEDA by going to the website called which is veda.com.au. And basically every person that's listening to this webinar has a credit file that is held by VEDA, and the credit file has different sections on it. It has things like your current residential address, your employment status, your past residential addresses, your past employees, if you're a director of any companies, but it also has things like if you've been late on repaying your personal loans, and there's also sections about bankruptcies, insolvencies, and obviously when you're applying for loans, they also make a mark on your credit file. So number one thing is you should always have a copy of your credit file. You can get a copy for free, but just by calling VEDA. or go to mycreditfile.com.au. Just get a copy, have a look at it yourself. Generally speaking, the less traffic you have, the better. Every time you apply for a loan, the lenders will look at your credit file, so it's not something that you can get away from. So the best thing is just to be aware of what's on it and have a look at it. If there's any credit impairments, there are companies now that you can Google that can repair your credit file for a fee. You know, even now, things like telco hits, if you're late with Telstra on your telephone bill, that can stop you from borrowing money to buy an investment property. So this is probably one of the most sensitive parts of your assessment criteria that the banks look for. So definitely something you need to be aware of. Equity is basically how much you put into the deal. Generally speaking, providing there's no postcode restriction on the property, as long as you can come up with a 20% deposit and closing costs, legals and stamp duty, the banks will give you the other 80% without lender's mortgage insurance. The moment you borrow above 80%, you have to pay lender's mortgage insurance. And there are two lender's mortgage insurance underwriters in Australia. There's Genworth, GE and QBE, and there's also the self-insuring underwriting department of different lenders. You can still borrow up to 95% plus lender's mortgage insurance, and in some cases you can borrow up to 99% depending on the lender. But once again, majority of people, 90% of loans get rejected, above 80% get rejected by GE or QBE. So, and what they look for is really an excuse not to give you the money, because every time you're borrowing above 80%, you have to pay for the privilege, and that's why you're paying an insurance premium. This is probably the only insurance premium you're ever going to pay in your life where you don't actually get the benefit of the insurance policy itself. The insurance policy is in favour of the bank, and the bank is basically insuring their position just in case you fail, so they can recoup their money without making a loss. Genuine savings is also something that lenders look for. And here's the important thing to understand is that the definition of what constitutes genuine savings varies drastically across different lenders. So if you're borrowing 95% for an investment loan, you generally speaking must have 10% equity in another property. If it's an owner-occupied, you can get away with 5% saved over a minimum of 3-month period. Some lenders will accept 6 months. If you're going 90% investment loan, you must be able to show 10% equity in another property. Owner-occupied, 5% to be saved over a minimum of 3-month period. There are a few lenders that would consider 90% non-genuine savings. 85%, not LVR investment, no evidence required, and 80% not required. Here's the interesting thing is that genuine savings has very different definitions depending on different lenders. So definitions, what are the definitions? For example, number one is the obvious one, which is genuine savings, or savings gradually built up over a period of time. Number two could be lump sum deposits, term deposits, held in an account over a period of time. Number three could be shares held over a period of time. Blue chip shares also, you can satisfy that criteria. Number four is consistent on-time rental repayments to a real estate agent over 12 months. Number five, accelerated repayments on personal loans or credit cards. Number four is interesting because in Sydney we had this situation where, you know, especially in the North Shore, there were professionals on 150 grand a year, white-collar professionals with stable PAYG jobs that could never save any money for a deposit because their rental that they were paying on their properties was so high, and they had such a high and expensive lifestyle that even though they were actually, you know, paying all the bills on time and they had a good rental history, there was no money left over. So the banks understood that and they said, okay, well that's cool. We understand that you're paying $1,500 a week for your rental. We know that you're making a lot of money. We'll accept your rental repayment history from your real estate agent, showing that you've been consistent on time, as our definition of genuine savings to get you across the line to get into property. So one of the important things about these 5 different parts of lending, which is slice, is that at the end of the day, the interest rate has very little to do with the product that you should seek out as an investor. You've got to be aware of all these other factors that are very important to consider when you're applying for loans. And that's why what I always recommend is getting together with a really smart switched on mortgage broker rather than going directly to a bank, mainly because mortgage brokers have access to 30, 40, 50 lenders with 1,000 or 1,500 products at their disposal. But if you go to one bank, they'll only talk to you about their products and their specific lending criteria. Well, let's clarify some jargon, because there is a lot of confusing jargon in this industry. And as we go through this webinar, and I'm going to get to the really high-level stuff, I don't want this jargon to get in the way of anyone understanding of how to pay off your mortgage in record time and how to buy multiple properties. The first one is loan-to-value ratio, which I talked about in past slides. It's very simple, but it's basically the relationship between your mortgage and the value of the property. So LVR is basically your mortgage amount divided by the value of the property times 100. Now, the key thing here to understand is that the value of your property is determined by a valuer, a certified valuer, which is usually works independently, but who is commissioned by the bank to do a valuation on the property. So it's not what you think the property is worth, it's what the valuation says it's worth. So once again, to give you an example, LVR, we've got a property here, property value is 600,000, you've got a mortgage of 200,000, your equity is 400. So the formula here is mortgage amount divided by value of the property times 100. So we've got 200 divided by 600 times 100, 33.33% LVR. That's how you work out your loan-to-value ratio. Another one is equity, which is the amount of money that you can access in your property. Now, equity is, in a way, your current market value of your property minus the outstanding mortgage. So in this example, we've got a property of 600,000, this value at 600,000. How do we know that? Because we had a valuer go through the property. Loan is 200,000, so you've got an equity position of 400. Now, you might not be able to access the entire 400,000. Even though you've got 66.66% equity, generally speaking, you can only go up to the 80% mark of the property. So even though you've got 400 in equity, you only be able to go up to 80% of 600,000 to draw equity out. You can go higher. You just got to pay lender's mortgage insurance, and in a lot of cases that might not be worth it. Depending on your tax situation, depending on how aggressive you want to be with buying multiple properties. A line of credit is like a giant credit card secured against the equity component of your property up to the 80% LVR mark. A true line of credit has interest capitalization and non-mandatory repayments. These historically have been called evergreen facilities. A lot has changed since the new Consumer Credit Code came out, in 2009. Now there's a lot of very good redraw facilities that do a very similar thing. I'm still a big fan of the line of credit, especially with interest capitalization, non-mandatory repayments, because you can draw equity out of your property and then you don't need to make any repayments per month. The interest cost of holding those funds just reduces your balance on your available equity through your line of credit. So it capitalizes the interest, which is really cool. So you can draw equity out without making repayments. Let's get to part number 2. How do you structure your investment property portfolio correctly? And this is a very important thing to understand when we're structuring something. Buying an investment property is probably the last thing you're going to do. The first thing you do is structure yourself correctly. So here we've got a red house, which is your owner-occupied property. And let's say you want to buy 3 properties over a period of time. First thing to understand is that your owner-occupied property, the house you live in, is considered as bad debt. Why? Because it's not non-tax deductible debt. And it also is bad from the perspective that your owner-occupied property, the loan that you have against your owner-occupied property, stops you, or to some extent hinders your ability to borrow money to buy good debts or take on good debts, which are your investment properties, which are the blue properties. The most important thing is you need to make sure that all your properties are structured as standalone loans, so they're never cross-collateralized, preferably with separate lenders. So having 5 loans or 3 loans with one lender is not a good option for a lot of people. You want to make sure that everything's structured as standalone. So you're in control, not the banks. And I'll talk about cross-collateralization, disadvantages of that later on. As soon as you have equity, you can set up a line of credit, and you want to be market ready as often as you can be. You know, it takes a long time to get a property valued and get a line of credit set up. What I mean by a long time, it could take a month or 2 months, depending on the paperwork, depending on the lender, and depending on the valuation. You know, just getting valuations, i.e. getting the valuer to access the property while there's a tenant in, there could be a couple of weeks. So what I recommend with all my clients is that you always want to be market ready. As an investor, you always want to be monitoring the market, knowing the suburb that your property is in, and the moment you get a higher reference, i.e. a property that's sold at a higher price point across the road from your property or in the same suburb or the same postcode, that's when you ring up the valuer, get a new valuation, increase your line of credit. The more equity you have available in your line of credit, i.e. the more market ready you are, the better at investing you'll become, because when the opportunities present themselves, you'll be able to execute contracts, pay a deposit, and secure that property. The worst thing you can do is start getting market ready when there's an opportunity. Now, I'm not giving you financial advice here, but from a lending perspective, most clients get financial advice from a lawyer or an accountant, and if you're wanting to buy multiple properties like myself, most solicitors and accountants will give you the advice to buy them through a corporate trustee and trust, not in your own name. Now, the other advantage of this is if you want to buy multiple properties, you're going to find it very difficult to continuously accumulate properties in your own name. Eventually, what you want to do is deal with business banking. So this is one of the things a lot of people don't understand, is that the name of the borrowing entity, if it's a company or an individual, end up in a different part of the bank and a different part of credit. So you want to be in business banking and not consumer lending, which is a completely different part of the bank, and the assessment criteria is completely different. From my experience, my career in the banks, most rich, successful property investors with multiple properties or large property portfolios, over 10 properties, have them secured in trusts and corporate trustees. So in Victoria, for example, on the contract of sale would just be the company name. So we've got a hypothetical company here called Smith & Co. Proprietary Limited as a trustee for Smith & Family Unit Trust. If you're in Queensland, you've got to put both on the contract of sale. So every state has different laws about which entity appears on the contract of sale. In Victoria, if you're buying a property, you can put end or nominees on the contract of sale and then nominate the entity or the structure, even set up the structure prior to settlement. In Queensland, you can't do that. You're going to have double stamp duty. So it's very important that you have a conveyancer and a solicitor prior to you executing contracts of sale, depending on the state that you're in. The reason you buy properties in trust is for asset protection, because if you continuously buy properties in your own name, there'll be a domino effect if something were to go wrong. If you have properties, that means if you get sued by a tenant or an individual. If you do, anything in your own name is up for grabs. If you have things in trust and company structures, they can't take your assets because you don't own them. So that's a very important thing. So what I do is, I just look at what the rich do, and the rich don't own assets. They control assets through corporate trustees and trusts. Let me show you an example of correct property portfolio structuring. I'm going to show you some examples of these are the properties that I own. This is a property that I've purchased in Vermont, and we did a renovation on this property. It's a nice property on a 1,334 square metre block, worth about 1.15 million. The current loan that I have on the property is 765, 3 at 125, paying around 4.79% per annum on average. It's much lower now, it's about 4.5, plus outgoing. So you bring that up to about 5.5 realistically, because there's property management fees, council rates, things like that, land tax. So I'm paying about $42,995.97 per annum in interest repayments, and the monthly interest bill for that property is $3,500. The rental I'm getting there is $725 a week, so per month it's $3,141.67. So there's a shortfall per month of $366.33. That's without any tax deductions. After tax deductions, the property is cash flow neutral. This is a property that I have in Gladstone. It's on 1,014 square metres of land in the city, in Auckland Street, and it's zoned high density residential. It's actually a development site, and it's a nice Queenslander. And here are the financials for the Queenslander. I'm paying around, I've got a loan with Westpac for only $380,000, Interest rate is about 5%. That includes outgoings and everything else. Repayments per month are $19,000. The monthly interest bill is $1,583.33. Weekly rent's $450 a week. Monthly rent is $1,950. So this property is cash flow positive by $366.67. So I'm getting about $4,000 a year, $4,400 cash flow positive. So I've got these two properties here, and I've got a property that's cash flow negative slightly in Melbourne, in Vermont, which is a growth property on the big block. It's a 4-unit site potentially because it's a 3rd-acre block. And I've got a property in GLADSTONE that's slightly cash flow positive, and also it's a development site. And both of these properties are in a corporate structure, which through a fixed unit trust. So the net result of those properties is that per month it costs me 34 cents in terms of cash flow. This is without any tax deductions, just pure cash flow. So think about this for a second. What is property investing? It's obviously about money. What is making money? It's controlling an asset called property, and it's controlling an asset over a long period of time. These properties cost me zero to control. You know, if you look at the rental's covering all the repayments. I mean, this property is actually 34 cents cash flow positive, both of them per month. These properties are growing at, you know, whatever they're growing at, 8% per year. I mean, these properties, you know, Vermont's probably 1.15, GLADSTONE's probably around 500, 450. You know, so I've got about $1.5 million there. If they're growing at, say, 10% on average per year, that's $150,000 a year that I'm making on these properties. These are just two of my properties that I own. You know, I own many more properties. But let me talk about the psychology of ownership and property. I don't own them in my own name. I control them. So I've got the benefit, but I haven't got any liabilities associated with never losing these properties if someone sues me, because you can't sue me. I don't own them. I'm not on the title. I control the assets, but I'm controlling them with other people's money. You know, when I really got this, and it cost me nothing to hold on to, and I'm making $150,000, give or take, per year in capital growth. When I understood this when I was in banking, it just became a question to me, well, how many times, first of all, it was like, I can't believe it's that easy. Number two is, how many times can I replicate this structure and set this structure up over and over and over and over? Because the more of these you set up, the wealthier you become. Think about this. Think about 2005 if you bought 2 or 3 properties like this in Melbourne or in Queensland in a good area and just held them for 10 years. I mean, properties have tripled since then. You know, where would you be today if you just had 2 or 3 additional properties? Well, 10 years from now will be the same. You know, so to me, the psychology is, and this is exactly what the rich do. They control assets through corporate trustees and trusts. They buy growth assets and they just sit on them, and they use other people to pay for them, which is exactly what this is. And I'm not contributing any to these properties, nothing. They're making me a little bit of money. I'm getting a lot of tax benefits, which is allowing me to get rid of a lot of my income, which is really cool. You know, so a lot of my tax gets written down because you get to depreciate the properties as well, and you get to claim the interest component on the loans. So that's what really property investing is. For me, anyway, it's about how many of these things can I set up over and over and over. Now, here's a couple of rules of the game. Do not cross-collateralize your property portfolio ever. What is cross-collateralization? This is where one loan is structured over 2 or more properties. And this happens all the time. So let's say you have a house and you know you've got a bit of equity. You were inspired by my webinar to go out there and buy an investment property. So let's say you go to your local bank and you say, listen, Mr. Bank, I want to buy an investment property. They go, yeah, no problem. We'll give you 106% finance. You go, what? I didn't think that was possible. No, we'll lend you the whole cost of the property, plus we'll give you all the closing legal fees and stamp duty. Oh, okay, great. What you don't know is that they secured the property with one loan against 2 assets. So you buy that one, you come back again, and you say, well, I want to buy another one. They said, great, no problem, we'll give you another loan. And even the third one, depending on your income and depending on how much equity you had in the first one. And what you've done there is you've allowed the bank to secure all 4 assets with one loan, which is the worst thing you can ever do as an investor. And then the banks turn the taps off. And this is where the problems occur. Whenever you try doing something to one property, they have to value all the other assets. So let's say, for example, you have a house, a red house in Brunswick, okay, in Victoria, good suburb. You've got an investment property in Moorooba, second investment property in Karratha, and the third investment property in Brisbane. Let's say in Brunswick you've got about 300 in equity in your house and you want to draw out 150 grand and extend the property and put a new bathroom in. Now, even though you might have the equity and you get a value out to your property, because Karratha has plummeted by 300,000, which is exactly the amount you have equity in your property, you can't get the equity out, because the moment that they value one, they have to value all the others. Or let's say Moorooba took a dive. So you might have 4 properties here. 2 of them could be doing really well, Melbourne and Brisbane. The other 2 are in mining towns, and now they're down. I'm not saying they're going to be down forever. I'm just saying at this point in time, they're getting down. And then, you can't get the equity out. You can't do anything. Let's say you want to sell Brunswick, and you want to upgrade to another suburb, to Yarraville, for example. So you sold Brunswick. You think you've got 300 in equity. The moment you sell it and you've got the equity, they value all the other 3, and they have to make sure the LVR is the same. So you might sell Brunswick, you might not be able to get access to any of the equity that you've derived from that sale, which is incredible. So cross-securitization or cross-collateralization, depending on if you're British or American, same thing. One loan secured by 2 or more assets is the worst thing you can do as an investor, because you're giving up control over your properties, and you're allowing the banks or the lenders dictate what you can do, what you can't do individually with your properties. So always remember, when you cross-collateralize your properties, you understand that whenever you do something to one, they have to value all the other assets at the same time. So it's just not a good thing to do. Bank is a place that lends you money if you can prove to them that you don't need it. DSR ratio. Let's talk about the key to understanding how to build a multi-million-dollar property portfolio. I've been hearing a lot of stuff about buying 10 properties over 10 years. There's a lot of ebooks, a lot of companies talk about 10 over 10, which is pretty cool, and hey, aim for 10. If you get to 6, I'm sure they're going to be too depressed. But let's talk about that. Let's talk about how these people really buy 10 properties, because the thing about myself is that I actually looked after a lot of clients with more than 10 or 15 investment properties, so I understand exactly how they're structured and what they've done, which is essentially what I'm teaching you here tonight. Now, this is a formula that there's 4 ways the banks work out how much money you can borrow. The main one is DSR ratios, which is a formula that the banks use to assess your maximum borrowing capacity as an individual. Now, the formula is very important to understand, because it'll give you a gut feeling about your scenarios and how you can structure yourself. The formula looks really simple at the beginning. It's just annual loan repayments divided by eligible joint income. Well, let's extend the formula even further, and let's talk about different parts of the formula. Let's talk about annual loan repayments. Most residential property investment loans are interest only. However, when calculating DSR ratios, the banks work out the loan repayments as principal and interest, and they add 2% to the interest rate. So what they do is, for serviceability, this is just an internal calculation, by the way. Even though you're getting the interest-only loan for 4.5%, they have to make sure that you have enough money left over, assessable income, to service the loan at 6.5% principal and interest. So that's one part of the formula. The other part is eligible joint income. What constitutes eligible joint income? And generally speaking, the banks will only consider 30% of your wages towards your loan repayments and 80% of your rental income. That's what constitutes eligible joint income. So if you look at the formula further, you've got annual loan repayments, even though you're doing interest only, and you're getting really good interest rates. For serviceability calculations, the banks work out the loan. They convert the loan from interest only to principal and interest and add 2%. It's called the benchmark rate. And your eligible joint income is, they take 30% of your wages, your salary, and 80% of your rentals. So let me ask you a question. When it comes to serviceable joint income, what is more important? Which one will give you more fueling power to enable you to buy more investment properties? Your wages or your rentals? What's higher, 30% or 80%? You see, what most people don't understand is that your rentals to a large extent will determine how big your property portfolio will end up, not your wages. Your wages are important in order to basically qualify for the loan in the first place, number two, to get the first few loans, but eventually your entire property portfolio will be fueled by your rentals, because it's 80% of your rentals that will enable you to buy more properties moving forwards. So, do I buy cash flow positive or cash flow negative real estate? And this is the thing, I've been speaking a lot on finance for the last 7 years, and one of the dumbest thing I've ever heard is, and I keep hearing it, there's a generation of new educators and speakers, every year. Why would I buy a property that takes money out of my wallet every week versus a property that adds money to my wallet every week? Well, the thing is that you don't make money out of property out of the rental ever. Property is all about capital growth. If you bought a property in 2005 in Melbourne, for example, if you bought it in Sydney, you would have had no growth virtually the last 10 years, apart from the last 12 months. But if you bought a property in Melbourne, you would have tripled your money. So a 250 property in 2005, a house for 300,000, for example, is now around the 900 to a million mark. Your rental is only 4% in major capital cities. So you cannot make money out of your rental. The money is always in capital growth. And this is the main distinction between the rich and the poor. The poor always chase cash flow because they want to get out of their jobs. And the wealthy understand this, and they quietly accumulate wealth by building equity and buying growth assets, because you can convert equity into cash. I've used cash from my properties to buy holidays, cars, to spend money on all sorts of stuff. Even though real estate's not that liquid, i.e. it takes 3 to 6 months to sell property, from the moment you make a decision to sell to the moment you've got the money in your bank account, it's still real money. It's never going to be the cash flow that will make you wealthy. It's always going to be the equity that's going to make you in property. Let me show you an example. And by the way, I'm not giving you recommendations here. I'm just doing a hypothetical example. Port Hedland, I'm a big fan of mining towns, by the way. So, I don't want any questions. Oh, you just don't understand mining towns. I do. I'm a big fan. But I also understand the risk associated with them. But it's a risk-reward ratio. So if you look at Port Hedland, for example, you can still get 12% rental yields. And I'm using a property here for $605,000, purely just so I can show you the impact and the difference between a cash flow positive property and a growth property, or a negatively geared property in the major capital city, and how the banks look at both, and more importantly, how it affects your borrowing capacity as an individual. So if you look at this, you've got Port Hedland here, 605. If you look at Doncaster, okay, which is a good area in Melbourne, you're looking at a rental yield of 4.5% on the house that's worth $605,000. Now, this is the key thing. Let's have a look at both properties. And by the way, once again, I'm not recommending either Port Hedland or Doncaster. I'm just giving you the same example. Purchase price 605 for both properties. Rental in Port Hedland is 72,600. In Doncaster, 27,225. Interest-only loan on both at 5% is 30,250. 30,250. What the banks then do is, in order to assess your ability to repay the loan, they convert the interest-only loan into principal and interest and add 2%, which means that in order for you to borrow the money for those two properties, they want to make sure that you have $48,300 left in your eligible joint income part of the equation. Now, to contribute to your eligible joint income, or if you're a single person, obviously it's single income, they take 30% of your wages and 80% of your rentals. Now, let's take 80% of the rental contribution towards that part of the equation. So 80% of the rental, which is 80% of 72,600, is $58,080. 80% of 27,225 for Doncaster is only $21,780. So in terms of what it is, the difference between the two properties is this, that Port Hedland, the rental, 80% of the rental services the repayments on the principal and interest loan at 7% and still has a surplus of $9,780, which you can use towards servicing another purchase of another investment property. So they don't even need your income to add to the equation to get the property across the line. In Doncaster, however, 80% of the rental is only $21,780. So you still need to come up with $26,520 from your job income in order to get this property across the line. So if you're on 50 grand, if you're on 100 grand, they take 30% of your wages. So 30% of 100 is 30 grand. Would you buy the property in Doncaster? Could you get the loan? Yes. What if you're on 50 grand? What's 30% of 50 grand? 15,000. Could you get the property in Doncaster? No, because you're only contributing 15,000 to the formula, part of the eligible joint income, but you need 26,000. Could you get the Port Hedland property? Yes, because you don't need to contribute anything. It's already cash flow positive. So that's how banks assess your ability to borrow property. And this is a very important formula to understand for a number of reasons. Number one, people sometimes buy blue chip properties, growth properties, and they just get no's from everyone, they stop investing. You might not be aware, but if you go further out to regional areas or mining towns, you could qualify for a loan because the rentals seem to be high in those areas. So maybe just to get into the market, for yourself as an option, could be a regional area or a mining town, without giving you a specific recommendation. Number two, even if you want to buy just growth properties in the major capital cities, and I've got clients that just want to buy, we just want to buy, in Victoria, just Bayside, like if you're from Sydney, it's the North Shore. Well, if you put in properties in between that are cash flow positive, what will happen is not only will you end up with more property, but every time you put in a cash flow positive property in between your growth properties, you can borrow more money faster. So you can actually accumulate more growth properties by mixing your property portfolio and having a match, different properties in your property portfolio, and having a mixture of cash flow positive properties and negatively geared growth properties. This is where smart investors on very low incomes buy multiple properties. If you look at the Australian Property Investor magazine, there's always like people with someone's on average incomes, but they've got 7 or 8 properties, and people go, how the hell did they do that? I can't even get one loan. Well, they did that because of this formula. They either did it without knowing or they understood this formula. But this is the essential mechanics of how banks assess your borrowing capacity. If there is a secret to wealth creation, guys, through property, this is it. These formulas are gold. This is how the banks assess your borrowing capacity. Important conclusion. You need to balance your property portfolio, because in these two examples we have a growth property in Doncaster which you need to find 26 grand 520 from somewhere else towards servicing this loan, and then you've got a property which is cash flow positive, which you don't need to find any additional income to service the property. It actually contributes $9,780 towards your next purchase of your next property, which is pretty cool. Once again, structure them standalone in trusts based on independent advice. So you must balance your property portfolio if you want to leave your job and replace your income. So having that fine balance and having someone that understands how to balance your property portfolio, and then the order that you buy those properties will determine how many properties you end up with and how quickly you can build a large property portfolio. And that's a very important thing. So the balanced approach is the one to take. So for every 2 cash flow positive properties, generally speaking, you can buy 1 growth property, if I had to really generalize that formula. But obviously it's different for every person because it has to do with your tax situation, how much money you bring in, how much rental you're getting from the properties, how much equity you have. So if you're under 50 grand, if your income is under 50 grand per year, you're paying 32.5% tax. Without giving you advice, if I were you, I'd just be buying cash flow positive property first. 50 grand, because you want to be buying property without affecting your lifestyle. If your income is between $80,000 and $1 or over, I would say you're paying 37% tax. Buy negatively geared growth property first, so property in the major capital city that's growth based, and then buy cash flow positive after that one, because then you can go again for the third one. If your income is between 50 grand and 80 grand, you need to call me because I need to have a look at your other stuff, like your car repayments, whether you have children, all sorts of stuff, because you could go either way. But this is really a generalized approach, guys, but I just want to give you a gut feeling of how do these people buy 10 properties, really? How do they get over 5 properties? And it's understanding these formulas. You see, most of the stuff has nothing to do with finding property. Most investors think in order to become a really skilled property investor, you've got to be an expert on finding properties. Yes, that's an important part of it, but that's not the most important part of it. 70% of your success as a property investor is finance, and understanding finance and having access to the right finance people. The other 30% is finding the right properties and making sure that you don't buy crap like in Dockland South Bank, or if you want to lose money, go to Gold Coast and buy some service departments, and you're going to be in a world of pain. Setting up and automating your property portfolio correctly. So let's have a look at this. How do you set this whole thing up, in a passive way? Because to me, the cool thing about property, and this is why I've been doing property for so long and why I believe it's the most superior way of making money, it's not only fun and interesting, right? It's just passive. And if you do all the work at the beginning, if you set yourself up correctly at the beginning, there's really nothing to do. The thing, it just runs itself. So let's talk about, first of all, what would you do at the beginning if you had to start? I'm assuming if you listen to this webinar, let's say you've got a house, for example, it's worth 500 grand, and you've got a loan of 200 or 300, you've got a bit of equity. The first thing that a mortgage broker will do, or a banker, is they'll set up a master facility or line of credit in order to unlock that equity and make you market ready, so you can actually have some equity that you can draw down and you can use to invest. And then let's say you find a property. I'm just using 500,000, guys, because it's an easy number. So you want to put down a deposit of say 10%, which is 50,000, and you want to have 25k there for stamp duty and legals, and you got a loan for 450. Most important thing is we would not cross-collateralize the two properties together. One will be with one bank, another one will be with another bank. The other thing is, and this is very important, you would actually physically do a check from your property. Let's say you're with NAB for your first property. You would write a check for the 10%, for the 50,000, and give that check to the vendor's solicitor, who will put that into his trust account. Your loan for the investment property could be with ANZ, for example. So there's no way you can actually have the two properties linked in any way. And this is a very powerful thing. Is it more paperwork? Yes, absolutely. Is it easy to have 5 properties with the same lender? Oh, absolutely it is. But when was something that was very easy the best way to make money? This is what everyone does. They take out the lazy option of just having everything with the same lender, everything with one loan. If you want to really take it to the next level, if you want to be in control of your property portfolio and you dictate the terms and you're in control of what you're doing with each property, you need to be aware of this. Best lines of credit, Bank of Melbourne, Macquarie's got really good products, Westpac, ANZ, Suncorp, AMP. The thing is, it depends on your situation, really. People always ask me, what are the best lines of credit? Well, these are some of the top ones, but once again, none of these might be relevant for you, depending on your situation. So let's talk about how to set up your property portfolio correctly. First thing is you need to set up a 100% offset account. An offset account is simply a BSB account number that's linked to a mortgage. It's not a loan. And the thing about an offset account is whatever balance is in an offset account diminishes the balance of the mortgage on a daily basis for interest calculations. So if you've got a mortgage of $500,000, for example, on your house, and you pack 100 grand into a 100% offset account that's linked to your house, at the end of that day, when they calculate the interest on your loan, because remember, interest is calculated daily on the principal balance outstanding, charged monthly in arrears. So at the end of the day, they calculate the interest on your principal balance outstanding. Your principal balance outstanding is only $400,000. So an offset account reduces the principal balance outstanding on your mortgage by the exact amount that is in your offset account at the end of business day that day, which is really cool. Now, some banks offer you partial accounts, partial offsets, or sometimes you set up an offset account but it's not linked to anything, which is not a good thing. It's like having a car with an engine, the engine is not linked to the car. So you want to make sure that it's linked and it's 100% offset. So you've got your house there. you've got your mortgage and you set up a 100% offset account. What's next? Well, next thing is you get a credit card, and normally you get a credit card 44 days or 55 days interest-free that's linked to your offset account. You also make sure that you auto-sweep the credit card, which means you program the credit card to be paid off to zero, okay, before the interest-free period expires. So what you're doing there is you're using the bank's money for free for 44, 55 days to live off and pay all your bills and all your living expenses. In the meanwhile, and the cool thing about this is with the offset account, you still have ATM access, you've got a checkbook, online banking, direct credits, direct debits. All your direct debits for your bills, so your Telstra, your gas, your health insurance, your car repayments, everything is set up as a direct debit against your credit card. So you've got to monitor and make sure you have, most of my clients, depending on who they are, but for a typical family, we set up a credit card for about 20 grand, 30 grand max. For a single person, it's about 10 grand, And you've got to be disciplined, guys. You can't just, blow the money and go to Crown, because that's not going to work. Essentially, the key is you have to spend less than you earn. Now, the next thing you do is your wages or your salaries get credited directly into your offset account. So remember, any balance left in your offset account on a daily basis reduces the principal balance outstanding on your mortgage. Your rental from your investment property always goes into your offset account, and any surplus funds, tax returns, anything you sell, if you anything you do, you always park it into your offset account, because that diminishes on a daily basis your balance outstanding on your mortgage. Your credit card gets paid off, on the 44th or 55th day, so you never pay any interest on your credit card. If you set this up correctly, you're going to smash your mortgage in record time. Now, let me just show you how that's possible, and I'm going to show you dollars an exact example. This is how people buy these 10 properties over 10 years. Now, to buy 10 properties over 10 years, it's never going to be one property every year. It's going to be, you refinance your house, you might buy cash flow positive property. Then you wait year 2, you buy nothing. Then you buy growth property. Then year 4, you buy nothing. Then you buy 2, another 2, and another 2, and that's how you end up with 10 properties over 10 years. Now, the reason you can set this up correctly is if you set this up correctly, you get extra equity in your house, which means you can buy more properties faster. So in this example, let's say you've got a property here for $500,000, you've got a principal and interest home loan. This is what most people do, and they whack a deposit of $100,000 into that property, and they do a principal and interest home loan. What you want to do, which is the worst thing you can do, so if you have a principal and interest home loan, you should never have a principal and interest home loan under any circumstances, even if your objective is to pay off one house. And I'll talk about why in a second. So what you want to do as an investor is have an interest-only loan. If you've got $100,000, for example, as a deposit, pay a $25,000 deposit and then put $75,000 in an offset account. That way, this is for your house, for example. That way, when you want to draw out money to buy investment property, you have the money accessible in the offset account. That $75,000 is available there for you to draw down and pay. So in terms of that, your rentals all get deposited into your offset accounts from your investment properties. So remember, when you get an investment property, I'm going to show you how the impact this has on your mortgage in a second in terms of dollars and cents. First, I just want to show you the flow of money. When you have an investment property, you fill out an authority with your property manager, and you specify where you want the rental income to go. And where you nominate the rental income is your offset account or sub-account of your rental income. What I mean by sub-account is you can have sub-accounts which are all linked to your offset account. And that's what it looks like. I keep it exactly like this. So at the end of the year, when I do my tax returns, I simply print off each account, BSB and account number, and I give it to my accountant so it's nice and clean. And I have a separate offset account for my personal expenditure. So in this example, you've got 3 sub-accounts, or you've got 3 accounts. Okay, one is an offset account with $75,000, and the other 2 are sub-accounts. I would link my credit card to the offset account with $75,000 in it to it. The rentals will be paid into sub-accounts, so you're not cross-pollinating your money. This is a little bit high level and micro level specific, but I think it's very important to understand this. So you park all your surplus funds, and then your rentals go in and out of these sub-accounts. So your main operating offset account is for you to live off your credit card, and then it pays your credit card off completely. And then your rentals go in and out of sub-accounts. So it's nice and clean, nothing's contaminated, meaning that you don't have your shopping groceries coming out of your rent deposit sub-accounts. So everything's separate, which makes it very easy for tax returns. So how do you smash your mortgage in record time? And this is where the gold is. This is worth so much. And what I'm about to show you will save you years of life, because effectively, you know, if I can save you 100 grand off your mortgage, think about how much time you spend driving to work, how many mornings you drive to and from the city or wherever you work just to make 100 grand. I mean, it's years because it's after tax. So you set up an interest-only loan against your house, but you set the monthly repayments as the same amount as the principal and interest home loan. Okay? Any surplus funds sit in the 100% offset account for 30 days. This essentially is making additional monthly repayments on the loan, as the parked funds sitting in the 100% offset account reduce the total interest that's payable each month. You see, on the interest-only loans, let's say you've got a loan where you're paying interest-only 2.5 grand a month, and your principal and interest is 3.5 grand a month. If you set your interest-only repayment at 3.5 grand amount, equal to the principal and interest repayment, every month when you make an additional $1,000 payment in addition to the interest-only repayments, you reduce the principal balance outstanding by $1,000 per month. And remember, every time you do that, next month, it diminishes the principal even further still. And any money you leave in your offset account reduces, any money held even for one day, reduces the principal balance outstanding for interest calculations, which is the same thing as making additional repayments on your loan. You see, if you just add $100 extra per month on the 25-year 500 home loan, which means you're just parking your wages in your offset, you save yourself 1 year and 6 months and $27,352.11. It's right at the bottom of the screen. Just $100 extra contribution per month on your loan. Now, I'm not talking about actually making a $100 contribution. I'm talking about just having money in an offset account sitting there and reducing your principal balance outstanding for interest calculations. If you make an additional $200 extra contribution per month on a 25-year home loan, you save yourself 2 years and 11 months and $50,765.44 over the life of the loan. That's 50 grand. But check this out, $500 extra contribution, 6 years and 2 months, and $104,608.17. $1,000 extra contribution per month on the 25-year 500 loan, 9 years, 9 months, and $160,000. I've just wiped 10 years nearly off your mortgage and saved you $162,409.22 just by setting up a banking package with an offset account, a credit card, and doing the whole thing and automating the whole thing. Now imagine you add a couple of investment properties to this. I mean, you could pay off your mortgage in, depending on what your rental from investment properties are, 6, 7, 8, 9 years without any problems. So let's look at a real example, because obviously I can't do an example when you're listening to this webinar because I don't know your situation. Let me show you a hypothetical example of what this really means. Let's look at a couple, okay, both are on 60 grand a year, PAYG. Let's see what happens if they park their fortnightly salaries into a 100% offset account. So let's compare what if they if they did this structure versus just doing principal and interest 25-year home loan. So an income of 60 grand a year, you end up paying a total of $11,847 in income tax and clear $926.02 per week, or $4,012.75 per month. So now let's keep this example simple and combine the couple, because there's two of them, obviously, husband and wife, after-tax income per month, which will equate to 2 times $4,012.75. So they're clearing per month $8,025.50 a month. So husband and wife, both on 60 grand per year, after tax, take home $8,025.50 per month. Now remember, $500,000 home loan on a 25-year term would cost $2,083 interest only a month, or $2,922.95 principal and interest per month in terms of repayments. And that's why people say, well, I want to do a principal and interest because I want to pay off the principal, where with interest-only loans, you never end up paying the principal. That's not true. What you want to do is get an interest-only loan, but make the equivalent of a principal and interest repayment. Because that additional $1,000, in this example, that additional $900 that you pay off the interest-only loan, listen to this, reduces the principal balance outstanding for the life of the loan. So 100% of that additional repayment, that $900, comes off the loan. What people don't understand is that with principal and interest loans, that additional, if you were to put another $900 repayment on the $2,922 repayment, that $900 wouldn't come off the principal. It gets appropriated. 90% of it would go off towards the interest repayment, and only 10% would come off the principal. And that's because there's a term in lending called forward loading, where the banks load the interest up front. That's why on the principal and interest home loan, in the first 5 to 7 years, you virtually don't even touch the principal. You're just paying all the interest to the bank. And that's the main difference between interest-only loans and principal and interest loans. So let's have a look at the scenario. You know, if you just did an interest-only loan and never paid a cent above the minimum interest repayment, this is what it looks like. You're paying $2,083 and you never touch the principal. But what happens if you structured this loan with an offset, but instead of paying $2,083 a month, you're making a repayment of $2,922 a month? It looks like, well, that's the principal and interest loan. It would look like this. So in this example, couple is salaries are going directly into the mortgage. They're left there for 44 days, just exactly as explained. And the couple pay all the bills using the interest-free credit card. On the 44th day, the credit card gets paid off completely by money held in the offset account. This is what happens, and this is what it looks like. Net monthly income, remember the couple clears $8,025.50 a month. Their mortgage repayment, it's interest only, but we're repaying the same amount as the principal and interest, which is $2,922.95. The monthly living expense for the couple is $3,000. The saving or the surplus is $2,102.55. Now, the thing is, whatever you're going to make a month, you're going to spend anyway, because your living lifestyle will catch up towards your earnings. It always happens. But in this example, it's almost like a forced savings. Below is the net effect of this new structure, assuming all additional savings are parked in the offset account. And this is what happens. With the new scenario, your home loan is, the orange line, is smashed in about 12 years. So the current principal and interest home loan will take in 25 years. The new home loan will take him to 10, and this is what it looks like. Interest only, original scenario. The original scenario is that you're paying on the P&I loan, principal interest 25-year loan, $376,885 in interest and 25 years. New scenario, you're smashing the loan in 10 years and 9 months, and you're only paying $147,110 in interest. You're saving yourself $229,775, 14 years and 3 months off a 25-year home loan. Can you imagine? I mean, it's insanity. Think about this. How many years would it take a couple on $60,000 each to save or earn, forget about saving, earn $229,775? And then after tax, I'll tell you how long, a lifetime. And this is why the average Australian ends up with one house paid off on retirement, asset rich, cash flow poor, because they don't know how to get rid of their mortgage in 10 years, and that's why they never invest in property, because they've got the wrong structure. I mean, when I was working for NAB and I learned this principle, and I learned the difference between interest only and principal and interest home loans, when it comes to structuring yourself, I mean, I could not believe that this is the case. Now, people often say, well, it sounds too good to be true, or why isn't everyone doing it? Well, think about this. Why would the bank educate people on how to save an average of $229,000 and 14 years of a typical 25-year home loan? I mean, it's never going to happen. The banks have conditioned the public to believe that the cheapest interest rate is the best thing to do with lending. I can tell you right now, interest rates have nothing to do with it. It's all about structuring your property portfolio correctly. Structure is what's going to save you money, not the interest rate. It's the interest rate on the loan that's going to save you money. It's the amount of interest that you pay over the life of the loan that's going to save you money. If you can restructure yourself and pay off a home loan in 10 years and 9 months rather than 25 years, even if it's a high interest rate, the amount of money you save is still 140 grand, 147,000. That's the key. So what's the next step? Let me show you an example of an investment property. I'm sure you guys are excited already about this. This is an investment. I want to show you how you can structure yourself and how you can accumulate properties and how easy it is to own properties. Now that I've saved you 15 years of your mortgage, and 150 grand, that additional money you can use towards the investment property. This is a development that I've sourced in Aspendale in Victoria, and I want to show you the mechanics of, now that I've shown you how you set up your house correctly, I'm going to show you how to set up your investment property correctly. It's a development in Aspendale in Melbourne, on the beach. It's 4 townhouses, boutique little project. In terms of the first thing you need to do is, if you want to buy an investment property, the first thing you've got to do is get an independent valuation. How do you know, for example, that you're buying a property, like this property is, for example, valued at 740 grand. How do you know it's worth 740 grand? Unless you're a quantity surveyor, you can't take the agent's word for it, and you can't believe the guy that's selling it either, because obviously vendors always want the highest possible price for their properties. Number one is you've got to get a valuation. Number two, in this particular example, because I own the Investors Prime Real Estate, these properties have been secured below market, so they're around. These 4 townhouses are between 20 and 15,000, and the middle ones are 50,000 below valuation. So with our group, with my company, because I deal directly with the developer and it's an off-market transactions, I can get things below market because I don't need to advertise them. You're never going to see them on realestate.com. You'll never see banners or posters or any kind of advertising. Just so you know, the average cost of promoting or advertising a property around $700,000 is around $20,000 to a developer. So these savings can be passed on to the buyer. Configuration of the property. This is a 3-bedroom townhouse, 2.5 bath, double lock-up garage. So I'm going to show you the mechanics of how to secure your first investment property. Now, by the way, I don't know your situation, so this is, for some of you, this is not a good investment property. I'm just giving you an example just so we can work with a real property. For some of you, this is a perfect example of a good property. For me, townhouses on the beach in Melbourne, it's very difficult to go wrong with them. But it might not be the best price point for you. It might be too expensive or too cheap, depending on how much tax you're paying, depending on what you want to do. Anyway, I'm just showing you a real example. Configuration of a townhouse, very good layout. You've got a master bedroom upstairs with an oversized bedroom, walk-in robe and an ensuite. And then downstairs, you've got open plan, paved, secure courtyard, double lock-up garage, 2.5 bathrooms, 183 square meters. Take away the garage, it's 143 square meters. So it's a decent-sized townhouse, on the beach. Number two, you've got to get an independent rental appraisal. You've got to know what the property will rent for. This property is renting for about $600 per week. You've got to have the owner's corporation contribution. So body corporate pays for insuring the building, the common areas. In this instance, it's $1,100 a year. Council rates, also $1,100 a year. And then you've got to get a depreciation schedule. So what I'm showing you here is not the property so much. I'm showing you all the stuff you've got to have in order to do a cash flow analysis on your first investment property. Now, every property brand new has a depreciation, has building depreciation, which is Division 43. You can see there's $7,773 per year. And you've got plant and equipment. Your carpets, your cabinetry, paint. So you get that as well. Then you've got stamp duty. Now, the advantage of buying off the plan is that you pay stamp duty on the land only in Victoria. Doesn't happen in Queensland. So this particular townhouse, even though it's worth $725, the land is worth $296. The bill is $444,000. So you're paying only stamp duty on $10,430. You're only paying stamp duty on the land component. If the property was established in Victoria, you would be paying $38,570 in stamp duty. You're saving $28,000 in stamp duty. That's why it's good to buy off the plan in Victoria. No other reason. I'm actually a big fan of established property, but I buy off the plan because of brand new, maximum depreciation, but also stamp duty. $28,000, guys, that's a deposit for your next property. You know, why would you give that to the State Revenue Office? They don't deserve it. In this example, we got a 3-bedroom, 2-bathroom, 2-car garage property, 183 square meters, $725 off the plan, $740 val. And the area at the moment, if you know Aspendale, it's booming right now. And this is a year and a half off the plan project, take a year and a half to build. So you've got equity on the way in, not too much, $15,000, and then you're very good chance of having equity over the next 12, 16 months. Stamp duty $10,000, $10,430. Weekly rental $600, so 4.17% rental yield, which is standard for blue chip areas. Depreciation $13,000, diminishing value. Bill and Mary Smith, let's have a look at an example. Bill's on 85, Mary's on 50. Good credit file. No, impairments. House with equity. They're borrowing 100%. Even though they're borrowing 95% plus loan to value rate plus LVR plus LMI. Always assume you're borrowing 100% because even if you're drawing equity from another property, you still have a cost of that equity. So it's always 100% borrowings. Let's have a look at the example. Purchase price is $725. Purchase cost $12,430. That's stamp duty, legals, or conveyancing, if you like. Current income $85,000. Tax $21,097. The rental is $600 a week, so you're getting $30,576 in rental per year. So what happens to your rental income? It just gets added to your normal income and becomes $115,576. But before you pay tax, you get to claim your deductions, $64,218. So your new taxable income, or Bill's new taxable income, drops from $85,000 to $51,358. New tax that Bill pays, $9,036. And this is the cool thing. All taxable income, $85,000. All tax, $21,000. New taxable income, $51,000. New tax, $9,000. You're saving yourself $12,000 in tax per year, which is $231.94 per week. And this is the magic of property. Interest repayments on the property, interest-only loan, $38,024. Depreciation on the building, fixtures and fittings, expenses, all-inclusive, loan costs. First 12 months, you get to claim $64,218 as a deduction, both cash, combination of cash deductions and non-cash deductions. Weekly costs, finance, $731.23, rates and maintenance, $152.96. So your total out-of-pocket expense for this property is $813.61, but here's the magic. Total expenses, $884.19. That includes absolutely everything, including council rates, property management fees, all associated expenses. Rental $600, minus tax, the out-of-pocket $52.25. And with the interest rates going down, they could even be lower right now. So if you're on $85,000, you can own a townhouse on the beach in Melbourne, a 3-bedroom townhouse, and all it's going to cost you out of pocket is $50 a week. Think about how crazy that is. Like, if you can save money off your mortgage and restructure a mortgage, why wouldn't you buy one of these? And then just hold it for 5 or 10 years and sell it. Go for a holiday. I mean, it's got to be better than just paying tax and doing nothing. That's the crazy thing. When I got this originally 20 years ago, I just thought, why isn't everyone buying investment properties? I mean, the system is designed to benefit investors. And here's the reason why you invest in the first place. It's not the rental. If you look at the last table, the red sections are how much you're contributing towards the property every year. But who cares? Because in year 3, look at the equity table. You've got $170,000. What do you do in year 3? You refinance, get the equity out, and you go again. And what happens in year 5? You've got another equity. and then you refinance and you go again. And remember, you've got another property from the property that you bought in year 3. That's how you get your 10 properties over 10 years, give or take. Look, the reality is, from my experience, I'm buying as many properties as I can, as often as I can, because the reality, what you're going to find is the paperwork involved and the time involved with one purchase is 3 to 6 months anyway. So I'm always refinancing, buying, and you end up only transacting once or twice a year anyway. So that's this thing about people going, oh, you got to get the timing right. Well, a load of bullshit. Seriously, like if they can pick the market, I can't pick the market. I'm a real estate agent in Melbourne, and they can pick the market. I mean, I can't even pick the market in the suburb I live in, and I know everything about the suburb. People go, oh, you have to buy at the peak or buy at 7 o'clock. I mean, what the hell are they talking about? Seriously, you buy as often as you can in the right areas because it takes forever just to transact. And then when the boom happens, you just fall into one of two categories. You either have property or you haven't got property. That's the reality of it. This thing about timing is just a lot of baloney. And that's coming from a mortgage broker, real estate agent, because I know how much time it takes to get one transaction across the line. Think about your house that you bought. How many months did it take you to get everything? The settlement's 60 or 90 days in itself, not to mention the paperwork and the research. Who pays the costs? Tenant, 67%, you 7%, taxman, beautiful, ATO, 26%, I love it. The red bars are how much you're contributing. Remember, $3,000 in the first year, and it just diminishes. In your rate, you're cash flow positive. You're out completely, and then you just own the asset. Tenant, 77%, you 3%, that's the average contribution over 10 years. So 3% is nothing compared, if you're paying tax, my God, you'd be crazy not to do this. And the reason we do this in the first place, guys, is just the equity. Even in year 5, you got 300 grand. Sell the property, give it to your church, give it to your kids. Buy a Ferrari. Go to Europe. I mean, it's got to be better than just paying tax. That's insanity. Just doing nothing and paying tax, I'll calculate one day that on 60 grand, Monday to Tuesday, even to Tuesday night, you work for the ATO every single week. Monday and Tuesday, everything you earn you give to the ATO, and Wednesday, Thursday, Friday you keep yourself. It's time to shift the balance in your favor. I mean, if you can afford $50 a week, or if you have enough equity in your house just to draw down $50 a week, I don't even know why people don't do this. It's crazy. What's the next step? Number 1, finance is probably the area that stops most people from buying property. That's why I wrote the book, Australian Property Finance Made Simple. You can get the book on my website. Just jump on bookonfinance.com.au. It's $32.95, and I'll throw in a bunch of freebies there. There's a bit of a video there on the website with my book. Also, I want to give you a very special gift just for making it through this webinar. If you've enjoyed the information that you've learned over the last hour and a half, I'm running a 2-day workshop in Melbourne on the 18th and 19th of April called the Real Estate Investing Fast Track. It's a 2-day event, and you can check out the website realestatefasttrack.com.au. Day 1 is all about finance. There's actually 2 other speakers apart from myself. There's a valuer / real estate agent, and a Stephen from Loans Australia, a mortgage broker, who's a specialist in his field, and myself on property. So it's 2 days of education. Tickets are only $97, which I believe, guys, this event should be worth $3 grand. In terms of the contents that I cover. I mean, think about what you've learned in an hour and a half. Imagine spending 2 days or 16 hours with me. You're going to get sick of my bad jokes, but I can tell you the contents that is covered in these 2 days is incredible. If you're interstate, fly in. I've got a lot of people flying into these events. In fact, some of the events I've ran, more than half of the room was from Sydney or other areas. A lot of people from WA flying as well. First day is going to be on finance and cash flow analysis and due diligence. I'm going to spend 6 hours just on finance. I guarantee you the stuff you'll learn in day 1 in finance is worth tens of thousands of dollars. I'm going to show you how to smash your loans in record time. So whatever your money you're going to spend on the ticket, which is free anyway, but flights and accommodation is nothing compared to the time the days and weeks of your life that I'll save you just by teaching you all the loopholes that I've picked up over the last 20 years. Day 2 is really cool because day 2, what I do is I take you out onto the road and I actually show you 5 or 6 projects through Investors Prime Real Estate, my company, so we can do on-the-ground due diligence and research, which is my favorite part of the whole thing. Now, these are very small events. There's only 40 available seats at each event, mainly because the bus on the second day is only a 44-seater, and we've got staff as well. So, you know, they book out all the time. There's only 40 seats available. Now, tickets $97, but if you put in the promotion code VIP2 free tickets 2015, it actually goes to 0. You still got to put your credit card details in there, but it actually, once you press that promo code, it just goes to 0, and then you can just check out with your tickets, and the legitimate tickets, but you don't pay anything for it. So amazing 2 days. You know, it took me, this is all the stuff that I've learned in 20 years, and I've condensed it down into 2 days of the most essential stuff that I've picked up, you know, over the last 20 years, essentially, since I was 18, I'm 38. So once again, if you enjoyed the information, I hope to see you there at the event. And that's about it. I finished on time with about 3 minutes to spare. I want to thank you for attending this webinar. I hope you enjoyed the information. I'm doing another webinar in a couple of weeks on property due diligence and research, how to conduct unbiased due diligence and research on the property market, how to uncover the best performing suburbs, some of the tools that you need to be aware of, some websites and software that you can use to uncover the best performing suburbs. And then, how do you know in those suburbs what are the best properties to target? Should you be buying a detached house, an apartment, a townhouse? And how do you really know what's the best property to buy in a particular area? So that's going to be another webinar that I'll be running in 2 weeks. So just make sure you keep an eye out for that invitation. For now, that's all. Really hope you enjoyed this webinar. I hope to see you in the future at one of my live events. This is Konrad Bobilak signing out, and I'm going to take questions right now. For the rest of you, thank you very much, and I hope to see you in the future. And any questions, feel free to email me directly to konrad@investorsprime.com.au.